Hello and welcome back to The Note. World stock markets are still at or near records, but mergers and acquisitions volume is still really quite low. Now there are signs that that's beginning to change. There are a few more deals in the pipeline. What does that tell us about the wisdom of some of those deals, and also what does it tell us about the prospects for the market? With me now to discuss this is the Head of Global Strategy for Standard Life Investments, Andrew Milligan. Andrew, thanks very much for joining me. Now let's start by taking a look at what seems to be quite a strong disconnect. Usually in cycles, deal volume tends to go in line with the level of the market. That hasn't happened this time.
Absolutely.
Why not?
I think probably what we've seen is the PE re-rating of equity markets caused by quantitative easing. So there clearly is a bit of a disconnect currently between market valuations, where the world economy is, and earnings. But if we are right that this is a mid-cycle part of the investment cycle, that the world economy is moving ahead, earnings will move ahead for the next couple of years, then I think the global M&A cycle picking up, which is what we would expect, will actually help revive equity markets and push them towards new highs into 15, 16.
Okay, so arguably it's all part of the attempt to press on the accelerator of QE, and finally it begins to revive activity in other markets.
As credit availability, for example, comes much more noticeable, moving out from the United States into the UK and now increasingly into Europe, for example.
Okay. Now, one other interesting trend, if we take a look at this next chart, is that normally, certainly back in the 90s, any time a company announced that it had bought something, its share price would take a hit. They were almost always dilutive deals. Now, whenever somebody does actually do a deal, they're rewarded, at least in the short term. How would you explain this?
Well, I think this chart absolutely is short term. It's just the first 48 hours after a deal, of course, rather than the market taking a longer term view. But I think we are at a phase of the earnings and equity cycle where previously investors were thinking about dividends, they were thinking about yield, they were thinking about values, valuations. Now more investors are saying, I want some growth, I want growth prospects, I want cyclical stocks. And they are beginning to reward companies, therefore, who come along with a compelling story that the M&A deal, perhaps a bolt-on acquisition, perhaps synergies, some cost reduction, whatever it is, will drive earnings growth forwards in the next phase of the cycle. And as the chart shows, we're beginning to see some reward by investors for those sorts of stories.
Okay, so the other encouraging thing is that the deals we're seeing so far are not the kind of loony deals we get right at the top of the cycle. This isn't AOL Time Warner.
There clearly have been one or two examples, particularly in the tech area, where people have been worrying about the overvaluations, the prices that have been paid. But the majority of them, yes, I mean, it may be a difficult decision between the acquirer and acquiring company, but investors generally think the valuations are sensible in the M&A deals at present.
Okay, now let's take a look at the links with the creditor market, with the availability of credit. And this chart certainly seems to imply that if the banks really are beginning to ease their standards again, that would mean more deals.
Absolutely, and I think we can look at these senior loan officer type surveys not just on their own, banks providing money, which for Europe is incredibly important. About 80% of funding for Europe comes from the banking sector, but also a general proxy about how capital markets, particularly the corporate bond side, are moving as well. The majority of deals currently are being done by cash, but in the later phases of the M&A cycle, very clearly that's when debt and bank lending begins to come through. And that's what we would expect to see. If this M&A cycle does pick up for the next couple of years into the latter stages of an investment cycle, then this sort of chart, I think, will begin to move quite noticeably. Banks will lend and help companies.
Okay, and now finally, this is quite an intriguing chart, looking at the amount of deals in context of global market cap. And on that basis, there could be a lot more deals.
A long way to go, yes. Although investment banks and such like have been pointing out how much M&A activity there was in the States in 12, 13, and Europe has particularly coming through telecoms, for example, into 14. Asia's beginning to pick up too. Actually, when you look at this chart and say to yourself, it's very, very low by historical standards. So if we are at all beginning to see a normal cycle, this should pick up quite notably. I mean, 2- or 3-fold more M&A is eminently possible, and that will probably include some mega deals. So far, most of the deals that we've seen are just small or mid-sized. We haven't seen the mega deals, the expensive ones, that might mark the end of the cycle. Hence, again, I think the M&A can drive forward with earnings, with the upturn in the global economy, to push equity markets forward.
Okay, Andrew, thank you very much indeed. Okay, obviously good news for investment banks. If he's right, I think also a very important point to make. the top of a market tends to be associated with a spike in M&A. This is yet another reason to suspect that even if stocks are already looking overpriced, the rally could well have further to go.